Welcome back, everyone. It's no secret that dividends are one of the most popular passive income strategies. Creating passive dividend income is very simple and easily accessible to all. All you do is purchase shares of a stock or a fund that pays dividends, and you're all set. Now you can kick back, relax, and watch that passive income start flowing in. Granted, if you don't have a lot of money, the passive income from dividends will be quite small, or it will take you a pretty long time to be able to invest enough money for that dividend stream to be large enough to actually have an impact on your life. I think this is where a lot of people that are interested in building a passive dividend income stream get caught up and potentially discouraged. Maybe you don't have a lot of money, or you just want a faster way to build passive income. If that is you, I don't think you should discount dividend investing just yet. I believe the real appeal in truly passive dividend income comes from setting it up in a passive and automated way, where you get to reap the rewards with very little to no effort. Investing in general is not easy, nor is it simple. There are tens of thousands of stocks and thousands of funds you can invest in from all across the world. With this many options, things can become complicated and scary. Where do I start? What do I buy? And when do I buy it? These are the things new investors ask themselves. And the best answer to these questions is it depends, which doesn't help you at all. Everyone is unique and has their own personal goals, risk tolerance, and strategy, and that's why no one path is ideal for all. Well, let's throw all that out the window for a second. And let me tell you about a simple path that will definitely leave you better off than where you are today. The reason index funds and exchange-traded funds were created was to simplify investing. Instead of choosing your own individual stocks, you can invest in a basket of stocks through one investment vehicle that will give you broad exposure to a segment of the market. You won't be hitting any home runs, but you likely won't strike out either by going down this path. While we all like to think that we are smart, reasonable people that can make educated investment choices, the reality is that most of us will not be the next Warren Buffett. In fact, we will fall far short of the real gurus of the stock market. Trust me, investing looks simple in hindsight. Sure, you knew that Amazon or Netflix or Tesla were going to be great investments. And it's easy to say that today, looking back at what these companies have achieved. But ask yourself, which of these three companies, or any other company for that matter, will 10x or 100x your money in the next decade? I think you'll find that question much tougher to answer. The safer and much simpler option is to pick a great fund that will give you average market returns in the long run. And for dividend investors, I believe one of the best funds on the market is Schwab's US Dividend Equity ETF, ticker symbol SCHD. It pays a pretty solid 3.5% dividend yield. It has grown its annual dividend at a rate of more than 10% per year. And since its launch in late 2011, it has grown at a compounded rate of more than 12% per year, placing it right in line with the S&P 500. Now, I don't know whether the same growth trends will pan out over the next decade or two, especially considering that the last 10 years or so have in general been better than average for the stock market. But I believe SCHD will likely deliver market average returns while paying better than average dividend income, and probably giving you better than average dividend growth as well. Instead of dwelling on what to buy and when to buy it, I think for the vast majority of investors, a more prudent path forward is to invest on autopilot into a solid dividend ETF like SCHD, and focus the time they would have spent researching other stocks and funds on figuring out how to earn and invest more money. Take a look at this example. SCHD has been around since late 2011, giving it roughly about 12 years of history. During its lifetime, the fund has compounded at a rate of 12.8%, a very respectable total compounded return. Let's say you started investing into SCHD when it was first launched, but you didn't have a lot of disposable money to invest. I'm going to say that you were able to contribute $10 per week. It's a very small amount, but everyone should be able to find $10 in their budget every week that you can save and invest. Over a period of 12 years, investing $10 into SCHD weekly would amount to a total investment of $6,240. Not a huge sum, but to someone that can only spare $10 a week, this can be a lot of money. Based on SCHD's actual return, your position in SCHD today would be worth around $14,860, a little more than twice your total contribution. And during this 12-year investment period, SCHD would have paid you roughly $2,300 in dividends that I am assuming were reinvested in this example. Not bad at all. The total lifetime dividend income is equivalent to a third of your total contributions. Okay, so now let's assume you had two options at the start of this journey. The first option was to spend a portion of your time each week researching stocks or funds you could invest in that would generate a better than 12.8% compounded return and grow your invested capital faster. And the second option was to spend that same time each week trying to earn more money that you could add to your SCHD position. Which option do you think is easier? Let's assume you can figure out how to earn an additional $10 per week during this 12-year period of time. That shouldn't be too difficult. You can do this with a part-time job, a side hustle, or any other creative way to make money. If you invested this extra $10 each week into SCHD, now your position would be worth around $29,700 after 12 years. Double the amount compared to just the initial $10 contribution. Simple math. If you didn't earn and invest this additional $10 each week, how much higher of a return do you think you would need to earn to duplicate the same results with more favorable market returns? The answer is, you would need to earn 10% more each year, for a CAGR of about 22.8%, to finish with a market value of about $30,000. Let me ask the original question again. Which option do you think is easier? Figuring out how to earn extra money each week, or getting a higher rate of return in the stock market? I think most of you will say that earning a few extra bucks per week is significantly easier for the average person to do. And look, it doesn't even have to be extra money. You could start by looking at your current budget and finding things you are wasting your money on today that you can live without. And boom, there's the extra fuel to speed up your passive dividend income machine. Once you have optimized your budget, then you can start to explore other ways to earn money. The best way to approach this is to think about your hobbies or things you already like to do in your free time, and finding ways to monetize those activities. The point is to pick a simple investing strategy. Set it up so that it runs on autopilot and try to feed it with as much money as you can. And in a few years or decades, it will grow and provide you with a truly passive dividend income stream that could fund your retirement, or at the very least supplement your income. In the meantime, you enjoy your life and figure out ways to earn extra money from things you enjoy doing. For me, it's creating videos and writing articles about investing. I do this in my spare time already, and with a little extra work, I get to share my thoughts with the world. It started as a hobby, but over time I have been able to generate a pretty decent side income, and I have seen my investment portfolio benefit as a result. That's it for today. If you enjoyed the video, please do me a favor and give it a thumbs up and subscribe to the channel. Thank you for watching and see you next time.